Kyle, welcome. But I'd love to start the conversation with Ukraine, because first of all, obviously it's on everyone's mind this week, but also because it's been a really interesting moment, it feels, in the world of crypto, with a lot of almost contradictory trends. This the discussion around Bitcoin being a hedge against market turmoil. This discussion around the Russians being able to bypass sanctions by using crypto. So, what do you make of it all?
Hey everyone, it's a pleasure to be here, and Matt, thank you for hosting this. It's really unfortunate, obviously, what's happening with Ukraine, and we have our best wishes out for the people there, and hopefully this all gets resolved quickly. In terms of crypto, there's a lot of different angles to think about this. A lot of people are saying you can use this to evade capital controls, you can use it and then that creates inherent political statements. I think what's probably kind of, regardless of your political views, I think it's pretty interesting that I think something like probably $30 or $40 million has already flown into Ukraine just via donations in the last like 4 or 5 days via Bitcoin, Solana, and Ethereum. So that can help move the needle for a lot of people. So I think it's important to see that. I think probably the most important thing that will happen from this is just increase awareness that crypto can be a force for good in the eyes of a lot of people. I think it'll increase awareness, it'll increase adoption. I don't think you'll have any serious political backlash. So I'd say overall net positive for crypto, although I don't.
Do you think that's going to accelerate regulation in the space? I guess.
Yeah, it probably will increase pace of regulation in Europe specifically. I don't follow European regulations as closely as I do American ones. The train has left the station. American politicians and bureaucrats are trying to figure out how to regulate crypto. That has been an ongoing process and will continue to be. This may accelerate that a little bit, but I'm not sure it will seriously move the needle. My sense is there was a lot of European countries that weren't paying attention at all, and that this is now, given Ukraine is not very far away geographically, is going to kind of force the issue for a lot of them. Net increasing the pace of regulation is net good for the industry as a whole because it reduces uncertainty.
All right, so that's being discussed. I'd love to start from the top and talk about Multicoin and your role in your job on a daily basis. So you're a VC in the crypto space. What does that mean exactly? What's the role of a VC in crypto, and what should founders expect from a crypto VC in a context where a lot of people are talking about getting financed in different ways in that space?
Sure. So in a lot of ways, my job is not that dissimilar from your job. I spend most of my time reading, thinking, talking to smart people, trying to figure out what the future looks like. So that's all fairly standard. I think where what we do differs from most VCs is in a few respects. First is, I would say the degree of overall portfolio correlation we have is, and portfolio synergy is much higher than traditional venture firms. Even for firms that are specialized, let's say a SaaS fund or a biotech fund or a healthcare fund or whatever, or even if you're like a marketplace investment fund, the amount of correlation between your investments is fairly low, and the amount of synergy between them is usually quite low. We, generally speaking, try only to invest if we have portfolio overlap and synergy. That is, by definition, riskier from a portfolio construction perspective, but also means we have theoretically more upside skew if we're right as a whole. And so a large percentage of our time is spent helping all of our portfolio companies navigate the rest of the crypto ecosystem, figuring out who to talk to in other sectors of the space, whether that means existing portfolio companies of ours or whether that means other players. We obviously spend a lot of time coordinating and helping those entrepreneurs build relationships, and we kind of host events for our founders to just help them get to know each other better, because our hope is they will all work together in these systems.
Right. Do you help with things like token design and more sort of specific parts of the crypto ecosystem?
Yeah, so I would actually say the thing that I think we probably do better than just about anybody is what I would call a full stack capital market strategy. The closest proxy to this in traditional world is investment bankers helping a company go IPO, but we do it in a crypto native way. So if you think about a publicly traded company, right, like they have earnings calls once a quarter. Those are very structured. You read text, right, basically, and there's a Q&A, and only a select number of people are allowed to be in the Q&A. you look at how information disseminates in crypto, it's like the founder tweeted something and like that was meaningful information, or like they posted something in Discord, or they like write a Medium post or a Mirror post or whatever. So the overall mechanisms for information dissemination are much more fragmented in crypto. And that means it's actually harder as a whole to convey what you want to the public at large, so they understand what is you're building and why you're building it, and all these things. So one of the things we do is a full stack capital market strategy. And so that means how to design the token economics of the system, how to think about value capture, how to think about staking rewards, inflation, all of these kinds of things. This means how to engage market makers and liquidity providers and exchanges. This includes what's messaged to the public at large. So that entire just set of processes and operations effectively doesn't exist in any startups anywhere in the world, because Series A or Series seed stage companies don't do those things, obviously.
What do you see in rounds currently in the way they're structured, and I guess how you advise founders to structure their financing, in particular equity versus tokens, and also the kind of syndicate that you want around the table?
Yeah, so the most common structure we see today in rounds is equity with a token warrant. That's I'd say 85 to 90% of what we do these days is that. Just because the mechanics are equity plus a token warrant, in practice, the only thing we care about is the tokens. We assume the equity is worth nothing. We don't really care about the equity. That's not why we're investing. The second part of the question is kind of round structure and composition. We generally prefer to be leads when we invest. That's not a strict rule, but I'd say we end up leading 85% of what we do. And our objective after that is to pull in everyone else that we think is value accretive. So I'll just give an example. We just led the Ceramic round that we announced a week or so ago. And Ceramic is basically you can think of it as a crypto native database for consumer social applications. And so in a round construction like that, wouldn't it be nice if you had a ton of builders in the space, a ton of people who build other Web3 infrastructure like the Graph and Arweave and other kinds of things. And so I probably personally facilitated 10 to 15 introductions personally. For Ceramic, we wanted to pull those builders into the round. And obviously a lot of those people we've either already invested in or I already have a direct relationship with. And so, when I call those folks and say, hey, we're leading the Ceramic round, they usually get pretty excited and we can kind of pull together a good round composition. Sometimes if you're doing something that has more kind of, I'll call it industry tie to it, so like a Helium, for example, or Audius or something else, we obviously very much want to make space for other strategics to be involved. We're fairly flexible on our mandate. We don't have strict ownership or targets for we need to own X percentage of the token or whatever. We don't have any mandates on entry valuations. We invest in things that at 10 million entry, we invest in things that at 8 billion entry, and everything in between. Danny and Michael and the team at Ceramic ran a very, very structured, methodical fundraising process. They picked us in USV to lead the round. And then they wanted to just pull in as many builders as they could because they recognized they wanted all these builders to leverage Ceramic in some way, shape, or form. So that was very direct on their part. And at that round size of 30 million, the bulk of it was us and USV, but there was still, many well in the seven figures of allocation for builders in the space. Our preference is on the earliest stages when you're talking $1, $2, $3 million tickets, that there's fewer names because you want everyone to care. It's very easy to spray off $25,000, $50,000 tickets and not care. But for the later stage rounds, we're very supportive of pulling in the ecosystem just to get the rest of the ecosystem bought in as something that starts to scale.
So you guys are well known for having made early and very successful bets on Solana and the Solana ecosystem. Do you want to walk us through the thinking, like how you identify it? Why did you decide to make those bets? Why are you so bullish on Solana as opposed to other L1s? So
there's a few things that kind of stood out to us about Solana from the early days. One was Anatoly's background. Anatoly, basically every other layer one founder has some pretty strong academic background of some form. And Anatoly despises academia, and that really stood out to us. Second, kind of relatedly, his entire career has been spent optimizing large-scale distributed systems. He's been doing this with cellular towers, with kernels, with operating systems, with storage systems at places like Dropbox and Mesosphere and others. He's approached the make networks of computers go as fast as possible problem for 20 years at like every angle and at every part of the stack. And that struck us as like very important kind of right background to think about doing these things. But the third and probably the most important thing that always stood out to us from the beginning was a real focus on use case. It turns out that the most important use case for a blockchain is trading tokens. Like that is by far the most important thing. And really, I would actually argue every use case of tokens is a derivative of people want to trade stuff. And if you think about trading stuff, the obviously most important question is, well, what's the price at which two assets are being traded? And the mechanism for pricing assets is well known and understood. It's called the order book. And if you look at the original Solana pitch deck, it was actually called Loom Protocol before it was renamed Solana. The subtitle of the title slide said NASDAQ for blockchain or blockchain and NASDAQ speed or something to that effect. Obviously, they dropped that messaging a long time ago, but their use case intention from V1 was always, we want to run an order book on the system. And that struck us, we, even in May of 2018, when the first round was coming together, we didn't appreciate the magnitude of the statement, blockchains are useful for trading tokens. I don't think we appreciated the simplicity and clarity of that, but it struck us as this guy understands a thing he really wants to focus on. And we understood that thing to at least be pretty important. We actually underestimated the importance of it. And for those kind of combination of reasons, we started to get very excited about Solana in spring, summer of 2018. Over the next 6 to 12 months, we would actually continue to increase our bullishness even more and our conviction more as we started to understand the Ethereum changing their scaling roadmap for the 7th time in 2 years. And then started to think about, as Uniswap launched, as Compound launched at the end of 18 and the early parts of 19, we started to recognize composability and what it was going to mean. A guy named Dan Elitzer wrote a blog post around that time called Superfluid Collateral, and he was basically highlighting composability in DeFi. The definition of composability is basically enabling one piece of state in these systems to be used in another application without the original developer knowing anything about what the future developer would do. Composability has existed in Web2. Broadly speaking, you can just call all REST APIs some form of composability, which is accurate. What's different about crypto is that the state is open and permissionless in addition to the API calls and the function calls. And by the state being composable as well, it unlocks new forms of things that weren't really possible. DeFi being the first example, and we're now starting to see data forms of composability on networks like Ceramic. But anyways, back in early 19, we started thinking about how are you going to make Uniswap and Compound talk to each other? And it was very obvious you wanted to do margin trading by combining those two things. And then we started thinking about scaling the number of users, and that's when the kind of the light bulb started to go off. The light bulb kind of went up, turned on, and we said, the most important thing you're going to need to preserve as you scale is composability. And the more you break the composability in these systems, the harder it's going to get to make these systems really intelligible and usable as you scale them. You can kind of take all of this all the way to its logical extreme, and probably the DeFi use case that is the logical endpoint of all of composability is the notion of a prime brokerage. And we in that keynote I just mentioned, I actually talk about a DeFi prime brokerage called MarginFi that we just announced an investment in maybe a week or two ago. And if you think about a notion of a prime brokerage, the whole point is you have positions across 5, 10, 30 different venues. You want them to all cross margin and cross collateralize and net against each other. And the only way to do that is with composability. And so
Solana is a high performance N1 blockchain in particular because it runs on GPUs. Is that correct? So it was like designed for massive scale. Is that the right way to think about it?
Yeah. So there's a lot of innovations in Solana that help make it go fast, but the most important two are the processing layer and the networking layer. So in the processing layer, they have a runtime called C-level. And the most important thing in C-level is parallelism. C-level runs natively on GPUs. Modern GPUs have 10,000 cores in them. NVIDIA GPUs have about 10,000 cores in them these days. That's like on a $600 graphics card kind of a thing. And you can run, execute transactions in parallel across 10,000 lanes. That's really the most important thing because you just get the absolute amount of computational throughput you gain. That way is very large. The other major breakthrough, or actually a breakthrough, it's just innovation in Solana, is that the networking layer and the networking protocol is called Turbine. The basic way to think about Turbine is you have data propagating between these nodes. Every node is sending one bit of data, it gets to two other nodes. Those other nodes are sending the data to two other nodes, and et cetera. It's kind of a BitTorrent inspired data propagation system. This is also done with erasure coding so that even if you have faulty data is being dropped as it gets passed along, you can still recombine the data at the end. And so this data structure is about as efficient as you can get for propagating data in a network through through a real-time network among nodes. And so that's what enables you to just obviously get the transactions between everybody.
So let's jump into some of the sort of investment themes you're excited about, and clearly, as you started alluding to through talking about Ceramic, Web3 infrastructure seems to be one.
My general sense of the world is there will be, in 5 to 10 years' time, a large class of applications that are predominantly user-owned. I don't think that necessarily means Facebook and Twitter and the Telegram are displaced. I suspect those applications, as they currently operate, will probably live and continue to operate in 5 to 10 years. But I think there will be new classes of applications where the users understand that a primary property of the application is that Facebook or Google or Telegram cannot manipulate it, and that users are in control of the system in some way. And if you believe that such applications will exist, then obviously you need infrastructure to power these things. And so we are probably the single most active investor across the full range of Web3 infrastructure, have been. I'll then highlight Ceramic and Fluence specifically, which we announced both of those about a week ago, maybe 2 weeks ago. Ceramic is what I think Solana is to asset ledgers. I'm hoping Ceramic will be to databases for personal information. So Ceramic it's not a blockchain. The thing that looks kind of like a blockchain, and it's certainly a blockchain-inspired data structure, but it is distinctly not a blockchain. The biggest goal in Ceramic is if you're going to enable decentralized Twitter or decentralized Reddit or Facebook, if you're going to get to that degree of scale, we're talking hundreds of millions of transactions per second now. You're never going to get that all on one global ledger that comes to consensus every few hundred milliseconds. That's just not possible. And so the goal there is, what if we split up the state with a sharding mechanism, and what if we actually limit specific notions of state so you can't have shared state? So we let Ceramic's been around for 12, maybe 18 months. It's kind of a pivot from a company called 3box that was building this thing called 3box IDX before. And we're very excited. Today, there's a ton of developers in the crypto ecosystem leveraging Ceramic. People like CyberConnect and ConverseSpace and Text and Satellite and LivePeer. A whole bunch of teams are building various kinds of social applications, Orbis and a bunch of others that leverage Ceramic. The other one we announced about 2 weeks ago was called Fluence. Fluence is arguably the most ambitious technical thing we've ever invested in. Certainly one of the most ambitious. The simplest mental model for Fluence is permissionless, decentralized AWS Lambda. And so the idea is, right, you can take any public piece of data, whether it's from Web3 or from a Web2 API call. You can issue a transaction to the Fluence network and say, go compute on this piece of data, execute sort of deterministic computation, and then deposit the output of this computation to some data source. Again, whether it's a Web3 store or a Web2 store. What is this useful for is actually kind of the key question. And so some examples are snapshot votes in governance votes are very useful to kind of compute and aggregate in this model. I expect to see a lot of on-chain games start to leverage this for various types of function calls between them, where if the developers of the games don't want the central server to manage everything, you need to have servers that have compute resources that are not local to the user. So I think we'll start to see a lot of game-centric function calls live on Fluence.
Cool. So just as a quick time check, we have about 5 minutes, and there's a couple of questions in the chat. Maybe let's talk about like a small topic, which is the reinvention of the music industry through crypto and decentralization.
Yeah, so I published a blog post on Friday last week called Rebundling the Audio Value Stack or Chain. The basic theory is the internet unbundled the record label. It took the distribution function and broke it off, and that by breaking off distribution from the rest of the record label function, it's created a lot of inherent conflict in the record label business model. And with the growth of Napster and then Apple and then iTunes and then Spotify, that conflict has gotten worse actually over time. Our operating theory is that you can recombine the record label value stack in a decentralized way where fans have economic interest and rights in the overall system as a whole, and that by introducing this new vector of ownership and revenue share and profit share, you can actually redesign the entire stack from risk sharing to marketing, distribution, and marketing and fan engagement, and then finally distribution. So we're super excited about this kind of rebundle. Music is without question the most important piece of creative outlet in terms of culture across basically all cultures. It's true in English, and it's true in Hindu, it's true in Chinese as well. It's the most under-monetized respect compared to its cultural impact. So we're super excited about the opportunity to change notions of ownership and monetization models of music. And we think that, hopefully the logical net conclusion of all of this is what we like to call a music VC DAO, all of which is referenced in my post that was published on Friday.
Okay, very cool. All right, a few questions from the group, and we're going to sort of jump back and forth between some of the topics we covered during this conversation. Question from Andrew: how many builders and developers are working on Solana worldwide, and what has been the incremental growth since the wormhole hacker event? And how do you see security as a future issue to rectify these hacker attacks?
Yeah, I don't keep track of developer metrics with a tight any closeness. The thing I optimize for, or I should say look for, is developers I'm willing to fund. I realize that's not useful data to most people. It's turned out to be very useful data for me. And it's obviously my full-time job to try and answer that question. I can tell you we have written in the last 6 months, invested in 20 to 25 Solana-based teams, and we've passed on probably 50 to 100 more that have been funded by other people. So there's hundreds of venture teams that are now venture-backed building on Solana. And that's really the thing to look for. I would look at number of people who can raise outside money is probably the best proxy. And there's data on that. The block publishes some stuff, and other people do as well. I referenced some numbers in my keynote presentation that is linked somewhere in the chat. So there's that data. The second question is kind of security and the wormhole hack and stuff. My general view of bugs in software is they don't matter in the long term. They're obviously very painful in the short term. But the general rule of thumb with software is you can encode anything in software that you can think in your mind. That statement must be true because that is kind of the fundamental premise of software. And so as long as you're not trying to solve a logically intractable problem, the problem is tractable. Bugs are bugs. It's unfortunate that people lost a lot of money. In the case of Wormhole, Jump can pay $300 million, and they did. It was a painful learning lesson, but not the worst thing in the world. In the long run, these bugs don't matter.
Question from Arjun. How do you think about the timing of hopeful crypto projects generating revenue or value external to the Web3 world?
I think the answer is not anytime soon for the most part. The instructive example here is the internet. And it turns out the substantial majority of early internet companies were primarily just people selling other internet things to each other. There were a couple of notable exceptions, eBay and Amazon probably being the most important. But for the most part, most of the other early internet success stories were software-y things for software-y people. Mark Andreessen wrote Software's Eating the World in 2011. And even in 2011, the iPhone was 3 or 4 years old. And it really took probably another 3 or 4 years after that before the iPhone started penetrating every single vertical, right? Like pizza delivery and whatever, guys in radio towers, using iPhones for documenting their work and all these other things. So it turns out forecasting timing is very hard of when do you get the real world impact for these kinds of things. So I have no real conviction on particular timing or how to measure real world. But I think that's actually the wrong question. I think the right question is, what are the new kinds of things emerging that are fairly circular and crypto-y for crypto-y people? And are those things interesting? And the answer to that question to me is overwhelmingly yes. NFTs are certainly very interesting. DeFi is very interesting. Creator monetization things are very interesting. Helium is super interesting. And so a lot of these things just have to be circular for a little while before they break into the real world. Most people are trained to believe that circularity is a bad thing because it oftentimes is kind of how you get to MLMs and Ponzi schemes and other things, which is true. But it turns out most of the biggest breakthroughs in the world required just a lot of circular belief and investment from a lot of people for a long time before they became viable. And so I kind of don't mind the circularity, as long as you see the fundamental progress continuing to improve, with some view of what's light at the end of the tunnel, then you're all good.
Great. Well, this is super interesting. This feels like a good place to stop this conversation. But look, you have such an incredible view of the space that I hope we can do this again from time to time. You can come back and check in. It feels like this, we could chat like another 2 or 3 hours at least. So this is great. Thank you so much. Really appreciate it.
Hey, Matt, thank you very much, everyone. And my DMs are open on Twitter. If you want to DM me there, feel free to.